Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We have the perfect guest on the state of the American economy. Frances Donald is truly a student of our holistic economy, each individual item of the algebraic equation of GDP. She is with RBC and their chief economist this morning. This could be a 2-hour conversation.
Sure.
Let's just begin with what Global Wall Street wants to know. Now what? What do they do in the speeches? What do they do in the discussions, the body language, when they've already modeled in another 2 rate cuts?
I think this is a Federal Reserve that is going to have to talk their way through some increasingly painful inflation prints because they have revealed their hand. I remember talking 6-9 months ago with you, Tom, and we were trying to figure out, when there's tension on both sides of the Fed's dual mandate, which way will they lean? Very clearly, there's a wobble in the labor market, and the Fed is jumping in immediately to provide support like an overprotective parent, I think, is the way that I'm thinking about it. But in our view, inflation data is going to become increasingly more problematic heading into year end, and not just on goods and tariffs, but also on services. So this is a Fed that's going to have to explain away inflation data a lot more in the next coming months.
And Paul, they just took on the Tiger Mom, Dr. Mirren, as well.
Typically speaking, how much impact do interest rates have on the labor market? If they want to address the labor market, well, cutting rates, is that going to help?
I love that you started with typically speaking, because typically speaking, absolutely, you would allow companies to be able to borrow more cheaply or reduce debt burdens. Mm-hmm. They would be able to focus on labor or limit job cuts. But what do you do when the nature of the job market has changed so significantly? Job losses are predominantly in trade-related sectors, and you have these big structural shifts that are pushing 1 in 3 jobs. 1 in 3 jobs right now are government, healthcare, or social assistance. That means that a third of the labor market is not particularly interest rate sensitive at all, and actually not really faltering.
Absolutely brilliant. And this alludes to Nancy Lazar up at Piper in Minneapolis, who's been absolutely brilliant on this. We're watching Intel as well with NVIDIA. Intel up 18%. Even NVIDIA lifts here as NVIDIA invests $5 billion in the beleaguered Intel. Frances Donald with us across America. Good morning, Canada. Thank you for joining us with the Royal Bank of Canada, and on YouTube as well. Subscribe to Bloomberg podcast. Francis, I look at the ballet yesterday, and there were some amazing, almost surreal responses within the show that we did yesterday. And I thought Jeff Rosenberg was really good about the dynamics change. And I said, I blurted out in my clumsiness, there's a whole new data dependency. Given this backdrop, they stagger from data point to data point, don't they?
I felt like it was more like a breakdancing than ballet yesterday, because there was a little bit more chaos and not necessarily super clear messaging. It didn't feel like it was very well choreographed in general, or at least there were dislocations within it. What I heard yesterday from Chair Powell, I know you've probably already talked about it 100 times, was there are no risk-free paths ahead. This was a haunting comment from a central banker, but it also reflects the underlying U.S. economy, which is that we are still in the air pocket before we will know the impact of this once in 100-year trade shock that has hit the U.S. economy. It is our view that there are still significant inventories in the United States, and we don't know whether companies will truly pass on those costs to inflation, or whether they will have to cut their own costs, and that will come down to labor. And so when you talk about data dependency, Tom, what I'm looking at is one single data point, which is how many inventories are left in the United States and how long until we answer that question, because neither of those paths are good, but they result in very different focuses from a central bank.
Paul, we started the show at 1:30. Tariffs wasn't mentioned until 2:16.
Oh, okay. Very good.
How odd. Yeah, I mean, tariffs is everything right now.
It's the Fed day. You guys are on top of it. So we had Mr. Myron, the new appointee to the Fed. He dissented and argued for more rate cuts, as I guess one would expect. That's in line with what President Trump would like to see. Other than that, it was unanimous here. We had some outliers before, but it's unanimous today. Was that important to you?
Well, unanimous in the sense that no one else formally dissented, but there were some silent dissents in there. There's certainly plenty of folks that do not see more rate cuts this year, one that sees a hike coming through. So there's a divergence of opinions on the Federal Reserve. And you know what? That's appropriate. It's appropriate for a range of reasons. One is that we have an incredibly fragmented U.S. economy, and this trade shock, the interest rate shock of the early 2020s has created, we've talked about it on this show, haves and have-nots, a K-shaped economy, but the trade shock is also a fragmentation in the United States. There are sectors that are feeling significantly more pain than others, and depending on which region you represent, it's appropriate to perhaps have a different view on what the appropriate path ahead is. So when I see that divergence happening between opinions, it's a reflection to me of the fragmentation and the spread that's occurring in the real U.S. economy as well. And maybe that's not such a bad thing that there's different perspectives about how to think about it and how to measure it.
Francis, thank you so much this morning. Francis Donalds gets us started strong here. This hour really focused on the Fed, the effect on global Wall Street. Ian Lyngen scheduled to be with us as well. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We are pleased to bring you, moments after he's published a detailed note, Ian Lyngen of BMO Capital Markets. Ian, within the many paragraphs of a Lyngen-Hartman note, there is a phrase, I've never seen this from the Fed, tone refining. What is the path forward from Mr. Powell and company as they tone refine the message?
Well, I think that yesterday was a very good example of the committee having one opinion and Powell choosing to offer a tone refining, more hawkish spin. So the market rallied following the statement because we saw a lower 2025 Fed projection or Fed funds projection. And then Powell came out and said, think of it as a risk management cut. And I think that that's why we saw the market whipsawed around a bit in here.
We talked to bond people yesterday. And folks, I want to get away from the jargon here. Lyngen's brilliant in avoiding the jargon. But when spreads narrow, that means bonds are bid, price up, yield down as compared to full faith and credit American paper. So, Ian, we're priced to perfection in the bond market, and your theory is we even get lower rates from here. How do we go from price to perfection squared?
Well, I think that what we're going to learn over the course of the next couple of months is that perfection in this environment means lower rates, it means a lower term premium, and it means a Fed that will deliver on an October and December rate cut and recalibrate the policy, the front end policy lower, which will ensure, or at least attempt to ensure, a recession is avoided and that the unemployment rate doesn't spike even further. So we're still hoping for a soft landing as a real economy at this stage. And that's what Powell's trying to ensure.
So, Ian, looking at the 10-year Treasury here at 4.05%, where does this go? I mean, are we talking sub 4% at some point in the near future?
Well, we were sub 4% yesterday, and I think that it's very doable to get to our year-end target of 385 for 10s.
Wow.
And if anything, at this stage, given where we are, I would skew that number a bit lower. Maybe we get to 375 or 365, and that's without an economic recession or a material slowdown. It's more of a glide path.
Do you think this move by the Fed yesterday suggests that maybe the labor market, maybe the economy, maybe they're seeing something that gets them a little bit concerned, more so than maybe the market is? Should we be taking that as a signal, or is this just kind of right in line with where they should be?
I would say that they're responding to the recent post-Liberation Day payrolls environment, combined with the benchmark revisions, which took off 911,000 jobs. And they're effectively saying the labor market's not as strong as we thought it was for the last 18 months. We need to start normalizing. What I worry about is we have another spike in initial jobless claims, which we will get that data this morning, and that gets the market concerned that the Fed's behind the curve.
Ian, I ended the show yesterday with our heads spinning. I mean, it was you and I have been doing this forever, and it was absolutely extraordinary yesterday. And I said, look, whatever the outcome here, the benefits of this financial stuff are the financial elites. How does what we saw yesterday, what I'm seeing this morning with the NASDAQ up to new highs, up 1.1%, how does that benefit Americans that don't own NVIDIA?
Well, on the margin, it's good for the broader equity market. So I do think that there is a bit of a broad-based wealth effect, but you make a very good point. The bottom two quartiles of households are struggling. We see this in some of the economic reports. We certainly hear this anecdotally, and it is going to be a very interesting next couple of quarters. Intel
up 26%. There was jargon from Lyngen.
That was
He's in the surveillance timeout chair. Bottom two quartiles, Paul, is half of America.
Yeah,
that's what Lisa Mateo would say.
I know.
She wouldn't go mathy on us.
Yep.
Continue.
Ian, what do you think the cadence of rate cuts may be for this Fed going forward here?
So I would say that it's going to be 25 basis points per meeting until they get to whatever version of neutral they think that they will achieve. Now, there's a case to be made that it should be 25 basis points per quarter, and that seems to be what Powell was pushing back or pushing for, suggesting that it's going to be a meeting-by-meeting decision. But getting back to 3% at 25 basis points per meeting, that would actually allow Powell to hand over the reins of the Fed to the incoming chair at 3%. Which I think would be an interesting setup for whoever comes in next.
So what do you think is next here, Ian, for this Federal Reserve? Are they going to sit back and kind of be consistent, i.e. we're data dependent? We, in fact, will look at this data going forward. Or do you think they have something predetermined?
I expect that if the data plays out the way that they assume that it's going to play out, that they have predetermined in their mind that they want to deliver a couple more cuts, maybe a total of 100 basis points between now and the end of the first quarter. And it's up to the data to derail that. So they don't need confirmation from the data. They just need not to see a spike in goods inflation or not to see a quick reversal back to a stronger labor market. So it is a bit of both, frankly.
Brahma brought up forward guidance yesterday, dead on arrival. I brought up a new data dependency. Take those trite phrases, Ian, and translate where we are on the death of forward guidance on a whole new world after all for data dependency.
I think that the reality is the more that the Fed is transparent, the more differing opinions that we hear, the more difficult it is for the market to know what the Fed is going to do. And so too many talking Feds can complicate things. And I worry that that's precisely what we're experiencing at the moment.
Ian, thank you so much. Ian Lyngen with us with BMO Capital Markets in this hour for Global Wall Street. All sorts of news flow right now. We need to bring that to you, but we're really trying to bring you pros in the street, picking up the debris of the Fed meeting. Thank you, Francis Donald. Thank you, Ian Lyngen. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now forever with his Goldman Sachs, but also a tour of duty with the Dallas Fed, Robert Kaplan joins us. And I really can't say enough, folks, the timeliness is technology elites meet with the prime minister and the president of this specific president. He is without question the most innovation, most business process president in modern history. Wonderful to have you here, Robert, this morning. What do we underestimate right now about this technology juggernaut? Without question, it's technology to the rescue. With all of your experience at HBS and all, what are we missing in this place forward a decade?
Well, I don't think the stock market is missing it. And this is why people are saying, gee, the economy appears sluggish. Why is the stock market at record levels? Credit spreads so tight. I think the stock market is seeing we are in the early stages of an AI data center power boom. And it'll take a few years, but as this technology gets adopted across industries, which we're in the early stages of, I think the market is anticipating it will create productivity improvements, margin improvements, S&P earnings improvements that will be transformative. The part we'll have to struggle with is how do we redeploy workers who lose their jobs in one area and go to another? But I think we will eventually figure that out. But I think the market's on this.
Okay, Robert, you were at Goldman Sachs, so this is just a really storied career in innovation, linking finance into America. You were at Goldman Sachs in 1990. You wandered in as a partner. And 4 years later, our world was turned upside down. I remember late 94, early 95, in the advent of the internet. Is this as ginormous as that moment?
It probably in a different way. Yeah, it'll be as significant for companies. The internet was very significant. I think this may be more significant for increasing the rate of disruption. Every company needs to be on their front foot on this because you need to find ways to be more efficient, to be more nimble, to do more with less. And so I think in terms of the breadth of this, I think the breadth in terms of affecting every company is more significant. Yeah.
Robert, when you talk to your bankers at Goldman Sachs, as they talk to their clients around the world, are your clients feeling the same sense of urgency as it relates to AI, the same sense of opportunity in AI?
They are. And it is a mix of anxiety and opportunity in that across every industry, people know they've got to be investing. It's not an option not to invest. And many companies are worried that they're not big enough, they don't have enough heft to afford the investment, because the first impact of AI investment may be lower margins, but you've got to make the investment because over the next few years, your competitors are doing it. And if you don't, you're going to get disrupted out of existence. And this is why we're seeing a lot of merger activity as a result of it. But yes, every CEO I talk to is trying to figure out which use case they have to get adoption. They're trying use cases. The thing leaders don't yet know, and they're working through, is which use cases will work and which won't. We'll know over the next few years, but you're going to have to go through this journey, and we'll try some things that don't work. There'll be a number of things that do work, and the net of it all will be a dramatic improvement, I think, in productivity. But it may be unpredictable in which areas.
Robert, one of the top news stories this morning we woke to was NVIDIA taking a $5 billion stake in Intel after the United States government made its 10% investment. That's really something that we haven't seen too often in corporate America. How do you view what's happening at Intel?
So it's part of a larger picture. So there's the AI boom that we can agree on. Okay, so what do you need to power it? You need semiconductors. You need sophisticated semiconductors. We need more semiconductor production capacity. We also, by the way, need more power. And we need more power capacity, and all this takes investment and collaboration. So I thought this is a positive development in that we need to beef up our semiconductor capability to power, to fuel a lot of these developments. I think you're going to see more of these kinds of things, and a lot of investment in the power sector, just the basic old power sector too, to drive data centers. But semiconductors are a key part of it, and I think it's indicative of this deal is indicative of that.
Robert Kaplan with us. We continue with the Vice Chairman of Goldman Sachs, of course, all of his work at the Dallas Fed. And somebody emailed me, are you going to ask him about DFW? No, I'm not going to ask Robert Kaplan to fix Dallas-Fort Worth and all the huge success of it, I should say. We welcome all of you in Texas. We welcome you across America, including Dr. Kaplan's Kansas. Good morning in Canada. Good morning on YouTube, worldwide as well. I love to do this, Robert, when you're with me. I go to the Dallas Fed, which, folks, check it out. That's brilliant, immediate economics. The Texas juggernaut, and even with the slowdown in June right now, and I got a great article on a relatively quiescent inflation in Texas. This by Luis Torres and Diego Morales Burnett. Robert Kaplan, what's the pixie dust in Texas that Montana, Mississippi, and Maine need?
Okay. So the story of Texas over the last 10, 15 years is migration of people and firms to the state. About 12, 13 years ago, I think population was around 2-ish million. We're now pushing 30 million and we're heading north. Why? So pro-business culture, very welcoming culture. Yes, no state taxes. And the reason the state is able to do no state income taxes, that is, has a sales tax and property tax. But the reason it's able to do that has a very large oil and gas industry that produces a lot of excess funds that go into the state's rainy day funds. We're the largest exporting state in the country. And so we've got a lot of features that make Texas a magnet in Dallas, Houston, Austin, San Antonio, a magnet for people and firms that are moving here and believe it's a better place to domicile.
I'm honored to say I'll be with the Houston CFA Institute next month.
There you go.
Going down there to
very good.
Do something.
That's great. Welcome.
Do something as well.
Very good.
They don't know that my father was a fighting Texas Aggie. If they'd known that, they probably would have rescinded the invitation.
Exactly.
Paul, save us here, please.
Robert, what did you hear from our Federal Reserve yesterday that maybe kind of got your sense going?
Well, I expected divergence, and you saw divergence. What do I mean by that? You got I think 6 or 7, which I kind of expected, who said we're done for the year. We don't want more rate cuts. You had then a 9 or 10 who said we're going to do 2 more rate cuts. So there are cross currents, and it doesn't surprise me. There's disagreement. But what you also saw yesterday, I think, is support and a desire to work as a team and work with the chair. And so you could have gotten more dissent yesterday. You didn't. And so it tells me that there's hefty debate and disagreement. That's great. But you also told me when it's time to make a decision, they came together and they made a decision. And so I think the Fed functioning, Fed independence without regard to politics is still alive and well. And I think that's what I saw yesterday.
It's kind of where I wanted to go, Robert. This is a Fed that's had to deal with arguably more political pressure, I guess you could say, on various members of the Fed. Do you think that impacts their work in any way? Do you think that impacts their policy in any way, or are they able to maintain their independence?
Well, so there's a very, very strong culture inside the Fed that demands you, to the extent humanly possible, and they are human beings, but to the extent humanly possible, you make decisions without regard to political influence or political pressure or considerations. And the peer pressure to do that is strong. Every statement I ever made at the Fed, I have to defend. If a colleague makes a statement, even if it's the chair, they've got to defend it. Otherwise, you're going to question them. People there have to stand on their own 2 feet. Make merit-based arguments. And so I think that culture is still alive and well there.
Robert Kaplan, I want to discuss with you the mandates. You are our most business, our most MBA, Richard Fisher and others, but I mean, you own the high ground on this. I guess we have an inflation mandate. I guess we have a jobs mandate. Stephen Roach of Morgan Stanley, iconic for saying we have an asset bubble mandate as well. Are we getting towards Stephen Roach's asset bubble when we see bonds priced to perfection and an equity market with Walmart a PE of 40?
I think that the Fed pays attention to financial markets, but it's got to set monetary policy based on the economy. And right now, you have a divergence. You've got regulatory reform coming. You've got tax incentives coming, accelerated depreciation, you got an AI boom. Those three things are not really in the economy quite yet. And so you got a sluggish economy and you have a booming financial markets. I actually think the tailwinds are significant. And so if you're at the Fed, on the one hand, you pay attention to it, but you got to set monetary policy based on the underlying economy, and I think that's the right thing to do right now, and that's what they're doing. This is not one of those stock markets that's being fueled by excess monetary policy, in my opinion. It's being fueled by other structural drivers, and the Fed would do well to recognize that.
Robert, one of the key themes coming into this year has been a new tariff regime on a global basis. As you and your bankers at Goldman work with your clients, are they feel like they're navigating their way through it, or is there maybe still some more pain in terms of higher inflation, slower growth? What are you hearing from your clients?
So bigger businesses are navigating through. The April announcements were abrupt, and they weren't prepared yet how to adapt. Since then, they've had time, and also the tariffs have settled out closer to high teens. I think they were hoping for low teens, but fine, they can work with high teens. You're seeing some margin erosion. You're seeing relooking at supply chains. The area that I'm seeing is struggling the most with it is smaller business. Smaller businesses don't have the levers that big businesses do, and I do hear from more small business people, especially if they import goods. Boy, I don't know if we can stay in business past the end of the year. So there's a divergence there.
Dr. Kaplan, thanks so much. A generous time this morning with Goldman Sachs, former president of the Dallas Fed. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The newspapers. Here is Lady Mateo.
Yes, we have to. Okay, so there were different approaches, right? It was the white tie fashion event, last night's banquet at Windsor Castle. So it was the First Lady and the Princess of Wales. They were the ones that were kind of the center of attention. Everybody was wondering what they're going to wear, okay? So you have Kate Middleton. They have two completely different looks, okay? So she went for this full-length Philippa Lepley gown.
Wow. Nailed it.
Yes, I had a call. We called the company this morning to make sure that was the way that you pronounce it. Yes.
But it was very Queen Mary. It was like wicked like Victorian.
Yes, very lace, full length,
Georgia.
up to the neck, long sleeves. She had the blue slash, the
Queen
tiara.
Mary would have approved.
Tiara, yes. The tiara actually belonged to Queen Mary that she was wearing. Right. She had this pearl encrusted clutch. She looked like a princess, basically. That was
she
it.
Nailed it.
She nailed it. Then you go to Melania Trump. She had this bolder approach. The yellow, yes. Carolina Herrera, sleek silhouette, with the slit up the side. It was an over the shoulder, chunky like purple silk belt around here, and then she had these long dangly green earrings.
Yeah.
So
I'm deferring
two completely. So you go from the plain lace to like this bold yellow, and so they were saying it was two different approaches.
I have to admit, when I saw it, I'll say diplomatically, I was constructively shocked.
You were?
It was, what a statement.
Well, it was completely different from how she arrived in the UK.
So at the next dinner at Mar-a-Lago, 200 people in the 200 people in the ballroom at Mar-a-Lago. How many people show up in Carolina? And they'll be like in 8 different colors. It'll look like Fruit Loops.
Totally.
Next.
Okay, we go from high fashion to what Starbucks employees can wear, okay? Because there are employees who were in 3 states who are taking legal action against the company, right? So before they have this new dress code, it went into effect. This is what it's going under. But before they were allowed to wear things like patterned shirts and colors and express themselves, okay? But now they have to wear in North America these solid black shirts, long, dark sleeves. They have to wear certain color pants and shoes. They can't have certain tattoos on their face or certain piercings.
Do they buy their clothes?
They change. Nope. They change and everything. They do not. No.
Who buys the clothes?
The employees buy the clothes, but they have to be of a certain color now.
Is that legal?
Yeah.
Well, yeah. When I was waiting tables, I know they used to
but
tell
you go
us
to
you had to wear a
McDonald's
black
and you got to
shirt.
wear the uniform. McDonald's buys a uniform, right?
I don't know.
Correct, but they're telling them what colors they can wear, like khaki pants, black
How much
shirts.
is the pumpkin latte?
Oh gosh, it's probably about $8. Yes, it's going if you get the super large one.
That's a venti?
Exactly.
There you go. See?
I still say large. I don't say venti. I haven't.
Yeah, thank you.
I'm taking some good coffee over in Italy, by the way.
Oh,
really?
sure.
Let's stop the newspapers right now. So out of St. Mark's in Venice with a big square. Did you go to the place over on the left that's like world famous?
Sure.
Like, they shot every movie there.
And they tripled the prices for everything. We had lunch there.
Sweeney walked in and they said, next.
Okay, this next story in the Wall Street Journal, you have to actually give it a good read, okay? So it's about AI agents getting ready to handle your whole financial life, okay? What could go wrong, right? Okay, so so people who manage their finances, you have a lot. You have different apps. You have a number of logins that you have to remember. You're trying to track all these different things. So tech and finance executives, they've been investing billions of dollars in these AI tools. Agentic AI. I was just talking to someone yesterday because we have a conference coming up from Bloomberg about this specifically. So they're saying, researchers saying AI assistants are going to basically examine your whole portfolio, give you advice on it. They're going to be key for financial, who can't afford financial advisors. People are going to turn to this now. But they are saying that, you know what, it's not going to replace financial advisors. It's going to be kind of a hand-in-hand tool.
Yeah, I'm not buying this whole thing. I think AI is going to take a lot of jobs. A lot of jobs.
It's tough. So they talk about a lot of the things in there. You got to read it.
The newspapers. Lisa Mateo, thank you so much.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.